Hello and welcome back to Options Arena by True Options Masters. I'm your managing editor, Mike Merson. I'm here with Adam O'Dell from Money and Markets, and of course, Mike Carr and Amber Hestla, our True Options Masters. Today, I want to talk to about something that's likely on a lot of your minds, especially if you're in the younger crowd. When is the housing market going to crash, or is it going to crash at all? There's a lot of worrying data out in the last few months, or at least seemingly worrying. We're seeing a lot of sale activity come down. We're seeing average mortgage payments skyrocketing, especially in the really hot West Coast markets and other places, as much as 50%. And there's this dynamic at play where why would someone that owns a house now sell it and then upgrade to a higher mortgage with a higher interest rate? Interest rates are going to keep rising. New home supply is up. The home builders are saying that home supply is going to rise. There's a lot of things that look really, really bearish and could potentially ignite another housing crisis. But I am not the expert. I am with the experts, and I want to know what they say about U.S. housing and hopefully give some of the younger generations a chance to own if they don't already. So I will take it right over to Mike Carr, who I know has very, very complicated thoughts on this subject, and I can't wait to hear them. Mike, what is going on with U.S. housing?
Thanks, Mike. Basically, we're reaching equilibrium. So the market was distorted. It was a bubble, not a bubble. It was a rush into homes. And now we're normalizing. So the latest data from the realtors shows that the average home is sitting on the market about 25 days before it sells. That's fast. It used to be 45 days was considered a good, healthy market. So even though we're hearing all the headlines say sellers are cutting prices, they're right-sizing prices. Prices are coming down maybe 3 to 5% on a listing, and it's just not significant. Now, Toll Brothers is a large builder, and they came out with their earnings. They said buyers are sitting on the sidelines. They're hoping interest rates come down. The Toll Brothers CEO said, we are not chasing them. We are not giving them incentives. We're not trying to lure them into this market simply because they're going to come to us when they realize there's a supply problem. The number of homes, it is higher than it was. The number of homes available is higher than it was, but it's still low by historic standards. We've underbuilt for over a decade. Based upon just Census Bureau data, we're short about 1.25 million housing units. So as long as there's more than 1 million units that we need, not on the market, prices are going to go up. Now, how do you trade this? I think home builders are the best trade here. And I want to show a quick chart. This is the home builders ETF. It goes up and down. This is a volatile market. Just put an indicator. This is my greed gauge on the bottom, and it's identified great trading opportunities. Right now, we're not on a buy, but XHB is moving at about twice the beta of the market. That means if the market goes up 15%, this has been going up 30%. Likewise, on the downside, if we see a 10% decline in the S&P 500, watch for a 20% decline here. XHB is a great way to get exposure to stocks and the home market. When it's on a sell signal, a put. When it's on a buy signal, use a call. Your favorite indicator can work. I use the greed gauge, but you can use stochastics, RSI, or whatever else you choose. That's it.
Very insightful, Mike. And I'll just add, if you want to start trading the greed gauge along with Mike, you got to check out his Precision Profits Advisory. More about that at trueoptionsmasters.com. All right, let's move it over to Adam O'Dell. Adam, what do you see for U.S. housing?
Yeah, so my opinion or forecast is right along the lines of Mike's as well. More recently, there's been some supply come on the market. We're seeing homes on the market a little bit longer, but we're still well below the long-term trend. You have to realize that a lot of generals want to fight the last battle, and the last major financial crisis, well, before the COVID crash in early 2020, was the U.S. housing property market crash. And it was really, that was more of a debt issue. If you looked at household debt to GDP ratios going into that crisis, they were rising steadily. If you look at household debt to GDP ratios now, they've come down 25 to 30% since that 08 top. And so really just the average household is not that leveraged. Household equity of the whole housing stock is at new highs right now. 40% of homes are owned free and clear. So there really just isn't that debt in there. Now, I like the characterization of a normalization, because really the price increases from, call it 2020 through early 2022 in the housing market were not sustainable. So I think there is a softening of the market, and there could be a slight pullback. I think that a lot of when you see, the houses are on the market and the sellers start to lower their offer price. I think that a lot of that was just fishing. They were just trying to see if they could get, 50 or 100,000 more than they could have a year ago. And if they could, then great. They'd try to figure out where to go. But I think that a lot of that was just fishing for high prices. And so I don't see anything that would trigger a massive wave of desperate sellers, which is really what we'd have to see to push prices down dramatically, 5, 10, 15, 20%. I don't see that. Now, obviously, the higher interest rates are kind of putting a quelch on demand. So the marginal buyer, the buyer that could barely, maybe doesn't have perfect credit and could maybe barely qualify for the mortgage that they needed in their housing market, they might step on the sidelines for now. But I think that there's still a ton of millennial buyers that are doing just fine. Employment so far is still holding steady. So I think that ultimately there's just a brief softening of the market, and then prices will continue to rise. And I also tend to think that we're in a secular upswing for commodities, real assets, the materials sector, the industrial sector. So I like Mike's XHB, the home builders, but I also like V&Q, getting access to REITs, real estate investment trusts, as well as XLB, the materials sector, and XLI, the industrial sector. So if housing continues to do well, cement and wood and all the real material products that go into building homes will continue to benefit from that.
Very insightful stuff, Adam. Thank you. I've been looking into the REITs myself as a way to play this, especially as they've been down, particularly over the past few months and so far year to date. So that's another great trade idea. Amber Hestla, champion of farmland and land ownership. I want to hear your unique perspective on this as well.
Thanks, Mike. So I was thinking, so when we see the headlines about home prices, they're based on national averages, and that's really not a good measure. So here in Wyoming, Zillow says the average price in the state's about $323,000. In Cheyenne, the largest city, the average is $389,000, about 20% more. In Jackson Hole, where Kanye West lived for a time, the average is $3.8 million. And in Rawlins, where the state prison is, the average is $221,000. So the point is that real estate is local. On oldhousesunderfiftyk.com, there are about 468 listings scattered all over the country. Some of those need work, some are in bad neighborhoods, some even look really nice. They're in small communities with good schools. 3 years ago, there may not have been good jobs in those communities, but a lot of that's changed now because jobs have gone remote. And so now those homes aren't, they're obviously not right for everyone. And but there are affordable homes available in almost every major metropolitan area. But, there are trade-offs. Spending $100,000 or less on the home may mean, an extra 45-minute commute. But right now, potential buyers seem to be resisting that. They want to believe prices in the most desirable locations will come down, but they won't. People who live there aren't selling at discounts, and they don't need to, since very few mortgages are in distress. And even if they did sell, they have to move somewhere else, and they're probably not going to want to pay high prices to do that. So sellers will resist deep cuts in prices in most areas. And that conflicts with headlines that tell us 1 in 7 home sellers cut their asking price. But those headlines are a little deceiving. Phoenix is a nice example of that. Almost 30% of homes listed for sale saw price cuts in June. And after the cuts, the average list price was, $548,500. So not exactly affordable housing. But the home market will change. Fewer homes will be available because sellers will hold out for the prices they saw a few months ago on Zillow. And as listings drop, pricing will firm up. So homes will remain unaffordable for many. But other potential buyers will accept that there won't be bargains anytime soon, so they can move somewhere a little more desirable than what they had dreamed of and get a nice house or continue renting at a crazy price and probably not building any equity. So as this process unfolds, it could unleash a wave of dynamic economic growth in smaller communities where homes cost less. High prices in big cities might be the best thing for rural America since John Deere added GPS to help fine-tune the seeding process in the 90s.
Wow, a lot to chew on there. Thank you, Amber. It sounds like millennials, Zoomers, anybody who's been waiting off on buying a home, now might be your best chance to buy into this softening while a lot of people are scared and holding off. So sorry, we probably won't see a housing crash anytime soon. Amber, if I could just bug you about one thing. I remember you released a report for our market leader subscribers a few months ago about farmland and potentially that is an option to build a house on later. Do you have any thoughts on that you want to share?
I still stand by that. I think it's a great idea. I have several local friends that are actually doing that right now. Even though prices are a little bit inflated, I think that land is always a great investment.
Awesome. If you want access to that report, be sure to check out Market Leaders. That's also available at trueoptionsmasters.com. You get started today for $4 a month. I also want to shout out Adam Odell's advisories over at Money and Markets. He's got some great picks going out, and Mike Carr, of course, as well. So that's going to do it for Options Arena this week. Thank you so much for joining. Be sure to like, subscribe, throw us down a comment. Are you buying a home right now? Are you holding off? Has your mind changed after watching this? We'd love to hear from you. And yeah, just thank you so much once again. Keep reading True Options Masters, the greatest option trading newsletter in the world, and Money and Markets, the greatest, more general purpose market newsletter that you can find out there. Thank you so much, everybody, and we'll see you next week.